Man, 2 hikes? That is some clickbait if I do say so myself. Let's get into what's going on with the Fed. Well, we're back to having the talk about the Federal Reserve, and this time the Fed actually exposes the banks. Well, at least Neil Kashkari does. Neil Kashkari went as far this morning as suggesting that banks shouldn't have deposit ratio requirements of less than 10%. They should be closer to, quite frankly, 40%. Now, that's basically to say that for every dollar of deposits that banks have, Neil Kashkari, who's a voting member of the Fed, thinks that banks should have 40 cents on deposit. Now, this is, dare I say, somewhat probably to the bankers extreme. Because even when we talk about getting to 10 cents on the dollar of reserves, bankers freak out and they're like, this is too stressful, you're causing too much undue stress, we can self-regulate, we're fine. Well, Neil Kashkari, and we'll talk obviously about this idea of a Fed pause as well here shortly, but Neil Kashkari makes this argument pretty strong, and he says, hey, look, y'all say, and y'all have always said that you can self-regulate, yet what have you done the last 15 years? Well, the last 15 years, you've made us bail you out 3 times. You made us bail you out in 2008, you made us bail you out in 2020 during COVID, and you made us bail you out in 2023. Something leaves Neil Kashkari thinking, hey, maybe, just maybe, banks don't know how to self-regulate. And quite frankly, how could you blame that? The reality is banks are motivated by profit, shareholder compensation, not just profit, but also, quite frankly, by being able to get a nice bonus when you're an executive, and you're able to generate a lot of growth for the company because you're able to attract more customers. Well, how do you attract more customers to a bank when you're a banker? Well, the way you do it is by offering sweeter loan terms, which potentially are more risky. For example, think about my first experience ever in my career with a local credit union, which I'm forever grateful for, and I hope credit unions don't go away. I love credit unions. They'll stick around. But I was able to go to a credit union on my first property, and after I refinanced the property and got a 20% down conventional loan, I was able to say to the bank, hey, would you consider giving me a home equity line of credit of up to 90% debt on the home without mortgage insurance? And they're like, sure, why not? And then there was an inflated appraisal to boot. So it's almost sort of like the credit unions are really incentivized. Like, hey man, whatever we gotta do, we'll stretch every limit we gotta. We'll grease the wheels of the appraiser just to get you signing up at our bank. Because of course, what do? Hey, but Kevin, we'll give you that, but we could actually get you another 1/4 point off the interest rate if you set up direct deposit with us. Oh, we could get you another 1/4 point off if you bring some more deposits over. It's all part of the game, right? Like, why would anybody go to a credit union over a too big to fail bank? Well, the only reason is because they have more competitive products. But by having more competitive products, you increase risk in the banking system. And Neil Kashkari is right to say, like, hey, well, the banking system has failed, basically, 3 times in the last 15 years. So it's kind of fascinating to think about this idea that, hey, maybe, just maybe, it's possible the Federal Reserve and Congress are going to elevate bank deposit requirements. Again, Neil Kashkari requesting up to 40 cents on every dollar. And the reason he says this is because, look, if there's a market crisis, when you have 40 cents on every dollar of cash that you have deposited, well, now you can cover all your mark-to-market losses. Remember how that works with treasuries, right? Let's say you have $1 billion of treasuries sitting around, and all of a sudden the market softens to where, treasury yields skyrocket and the bond values fall 40%. Well, at least you can still cover your deposits. Well, that'd be cool. It'd be cool to cover your deposits. Imagine that, a bank being able to cover their deposits. Well, that hasn't been true this year. So he actually doesn't make a bad argument. But unfortunately, what just ends up happening in our economy is anytime there's a strengthening of rules, the one president down or 2 presidents down just undo those rules. Now, this happened with Democrats as well, so this is by no means trying to be political here, but after the 2008 financial crisis, we had Dodd-Frank, which set up these massive too big to fail rules and created some really big restrictions. Especially on the big four banks, the Citi, the Bank of America, the Wells, the Chase. Consider for a moment JP Morgan. I walk into JP Morgan, I got all my banking accounts there and everything. And I'm like, yo, I want to refinance 28 properties with y'all. And they're like, we can only do 4. And I'm like, you're smoking crack. I want 20 Fannie Freddie loans. Let's go. They could do it. Why can't you? And they go, Dodd-Frank. I'm like, oh, that sucks. They're like, but we could offer you some non-QM loans. And I'm like, I don't want that crap. Get that crap out of here. I want my 30-year fixed Fannie Freddie, no prepay loan. And they're like, yeah, no, not from the big four. So I'm like, all right, fine. I'll go, to another lender, like a non-bank lender. I go, yo, I want 20 loans for my wife and I on all these properties. And they're like, no problem. Would you like, a donut to go with it? So you do have some regulations. Those regulations still exist. But then some other parts of Dodd-Frank got rolled back, like the audit requirements on banks with more than $50 billion in assets. Some of those got rolled back to where only banks over $250 billion in assets had certain stress test requirements, not necessarily audit requirements, stress test requirements, which to some extent is a form of an audit. But anyway, Silicon Valley Bank then ended up falling right under that threshold, right, at about 212, and so did many of these others that have failed. So it's kind of crazy that, even though we might end up getting more regulation, we're probably just going to keep having banking crises going into the future. Kind of wild to think about that we just can't even get banking straight. Neil Kashkari made this really good argument, and then I want to talk about his talk about a pause. He made this really good point. He's like, it's kind of like a nuclear reactor. When you have a nuclear reactor, your goal is to create as much energy as possible because, you want more jobs, you want to expand, you want to put another, silo up or whatever y'all call it. The problem is when it ends up failing, it's not the company that is solely responsible. It's the government coming in and bailing you out to make sure that everybody around that reactor doesn't, freak out like another Fukushima, knock on wood. I personally think we should be building more nuclear power plants, not less. The problem is nobody wants it in their backyard, but I mean, look at this disaster we've had with Russia here. Nuclear power would just be so incredibly logical. And then you look at what they're doing over in Europe. They're taking the spent fuel rods and they're just burying them, miles under the ground in these massive caverns they have. And it's like, cool, nobody has to deal with it. Great. So, because that's always a concern too is, well, what about the disposal? Okay, well, there you go. Put it in a cavern way down in the earth. When people are like, but what if it seeps through? Okay, you can't win everything, I guess. But anyway, Neil Kashkari talked a bit about a pause as well. And I really thought his mental gymnastics here, I'll go ahead and say were quite fascinating and entertaining. He takes this point of view that he's like, look, if we happen to pause, does this mean we can't hike again? It's hilarious because no, once you pause, you're done. You're done. They're going to tell us they're not done once they pause, but you can't. You can't do that again because of what you did in the 80s. You're screwed by the past. In the past, y'all did this. Stop, start. Stop, start. Stop, start. And you don't want that because as soon as you do that, you send signals to the market that you have no freaking idea what you're doing, and you double down on reiterating that you literally have no credibility, and you continue to give evidence to the market as to why, once again, you shouldn't be trusted. So, unfortunately, you're kind of screwed, because once you pause, you're stuck, in my opinion. Now, sure, could inflation really go nuts again, and then we really have to Paul Volcker and raise rates again? I suppose, in theory, that's possible. There's certainly no leading indicator of that coming. Is inflation plummeting exactly as fast as everybody would hope? No, of course not. New York Times actually, and I know, the New York Times, I get it. 50% of people hear me, oh my gosh, cite my sources, and then they freak out. But the New York Times actually had a good good piece this morning on one of the things that's keeping inflation high. And it's actually, in their opinion, used car prices and just car prices in general. So the New York Times said car prices, actually both new and used, have, quote, remained high, contributing to overall inflation. Used car prices have been so volatile, and new car prices actually continue to rise. Now that's weird because we are getting more incentives at the dealerships. So you have this bizarre way of potentially measuring car prices that's contributing to volatility, partly because you've got wholesale car prices, which are all over the place. Then you've got, MSRP prices, where back in the day we used to see cars sell for more than MSRP. Now they're starting to sell for less than MSRP, partly because of incentives coming in. But there are also still some lingering supply issues where even though supply chains are getting better, we're still not producing as much as we were previously because we are kind of still just recovering with the semiconductor shortages, which led to fewer cars being produced and fewer cars sitting on dealerships. It used to be you'd have cars everywhere, and we're still not back to those levels of inventory. So there are these ideas that even though wholesale car prices have started to decline and more incentives are coming, signaling, some potential easing in pricing strength for cars alone are holding inflation up. So sure, yeah, there are some things holding inflation up. I mean, just look at aerospace, okay? Aerospace is crazy. I mean, that they still have supply chain shortages. Like, if you want to understand supply chain shortages and inflation, buy a plane. Okay, don't do that. It's a really bad idea. It's a very small reason somebody would ever need to have a plane. Very small. Okay, so with that said, now what does Neil say about a pause? Well, he argues that, well, again, if we skip, that doesn't mean we're done. Yes, it does. If you skip, you're done because of history. But he makes this argument that, look, I hope the market is right about inflation falling. We have to get to 2%. We can't move the goalposts. And I, last time I went on a plane, I haven't seen any empty seats. Economy still seems to be doing just fine. Yes. But that's also kind of talking about two different issues here, right? Because remember, we just need, with the Federal Reserve, prices to flatten out. In other words, we don't need prices to go down. That would be nice. It'd be nice if the grocery bill was lower. But we don't need prices to go back down. What we need is pricing to stop rising as much as it is. And quite frankly, that has nothing to do with how many seats there are on the plane. And I think Neil Kashkari knows that. Even though he's making this example, when I travel, and it still seems like people are spending. People are spending because they have extra money to spend and they still have jobs. That has nothing to do with inflation. We had an economy where, oh my gosh, guess what? People spent money. And there was no inflation for the last 40 years before COVID. So realistically, this idea that, wait, people are still spending, I don't know, are we going to pause? Nonsense. I think he really set up the case here for, we're going to pause. His argument for, well, the only reason I would be convinced to pause is because of the banking crisis. By the way, I think we should have 40% deposit requirements. Notice now how it all comes together. You want 40% deposit requirements, which are 5 times as high as current deposit requirements are. And because you're not going to get those, and because you're so worried about the banking crisis, you're going to let the banking crisis define why you got convinced to go with a pause. He's basically telling you, yo, look, my arm's getting twisted to pause, so I'm just going to talk up how bad the banking crisis really is as the reason for my pause and supporting a pause, so we could all come across as having a unanimous opinion of pausing. This is why he's making the argument, we'll just pause in June, but July, we might go back up. Okay, Neil, whatever. So, in other words, bottom line, I think Neil Kashkari just went up and told us, in your lifetime, get used to banking crises. It's going to happen again, A. And B, he told you, have you checked out Kevin's programs on building your wealth and the June 1st release of the AI course? I hope so. I'll link down below, of course, as usual. And C, so number 1, get used to banking crises. B, courses linked down below. And C, pretty much guaranteed going to pause in June unless we get some kind of crazy CPI report the day before the meeting, which is kind of wild that the CPI report comes out just the day before the meeting. That means J-Pow's actually probably going to get an early look. He's kind of teased that before, that sometimes when they have a meeting really close to critical data, they'll pre-release the data to him, which is kind of cool. You know, somebody could like hack into J-Pow's Wi-Fi. That's illegal, don't do it. But if you happen to, you'd be able to probably find out what the CPI report was, you know, beforehand. And there could probably be some benefits to that. But anyway, so this gives you an idea about the latest, the Federal Reserve. You know, obviously, we're not going to be done talking about the Fed for a very long time. And quite frankly, when I started really making YouTube videos, I was talking about the Fed back in 2017. That's all we could talk about was the Fed. And back when I started my career, we were talking about the Fed. So it's just always Fed. It's crazy. Talking about the Fed so much, I remember in high school, it was the first day, and the teacher's just like asking questions of these high school students, seniors, and they're like, all right, who knows who the Secretary of the Treasury is and the chairperson of the Federal Reserve, or who knows this, and asking all these questions, and nobody's answering them, and I'm like, here's the answer. After the class, the teacher's like, dude, do you want to join us in like AP Econ? I think you'd do well. I'm like, nope, I'm playing WoW. No, I had a job at Jamba Juice and I was starting with real estate. So for me, I'm like, no. It was scale back on the school and focus on the biz. So anyway, yeah, and then I ended up at UCLA, which was also kind of cool. But yeah, so that's my take on the Federal. Oh, I gotta push this button. That's my take on the Federal Reserve. So yeah, look, same old. But I think the good news is if you're looking for the Fed talking about a pause and reiterating a pause, that's exactly what we got here. It's good. It is kind of fascinating, though, that to think we're probably gonna have more banking crises. His comment about 3 banking crises in the last 15 years. He's right. Kind of wild. Didn't even think about it. Yeah. Anyway. All right. Well, good to see you back. We'll start talking about something else. So Bullard is back to yapping. I thought the topic was done and over for the Fed, but no. Bullard is back to yapping. Yapping. Here you go. Nick T, 2 minutes ago on the tweeters, St. Louis Fed President James Bullard, whom, keep in mind, is not a voting member of the Fed. In other words, he really has no say, okay? Does not matter. Kashkari is a voting member. Bullard, not a voting member. The projection that rates would rise to above, just above 5% this year was based on the idea that inflation would come down pretty rapidly and GDP growth would be around 0. But those things haven't materialized so far. That's true. Inflation higher and GDP higher. Bullard thinks the Fed will need 2 more 25 basis point hikes this year. You've got fairly robust growth for the U.S. economy in 2023, and you've got inflation that's not come down fast enough. For that reason, I'm out. Well, actually, he said, I think we're going to have to grind higher with policy. In fact, Bloomberg's now talking about it. Let's listen in.
Let's review this, and I do think this is important, folks. Bullard has been a collegial outlier, agreeing with others that have been leading the charge, including the former New York Fed President Bill Dudley here. But a while back, he was giving scope and scale to a really significant reset in interest rates without any whisper of disinflation. I see a recapitulation of that this morning. Bullard saying inflation staying too high. One reason for more hikes, plural.
And we're
very plural this morning.
Well, and this is sort of the distinction between the skipping of the June meeting or the pause, right? The skip being there might be more needed, especially as you get data that's come out hotter than expected pretty much across the board.
And what we see is, a better economy, and that may include new cars, including new expensive cars from Dearborn. With a perspective on his world of autos, Matthew Miller joins us from Dearborn.
All right, well, we're not talking about autos right now. We got to finish with the Fed here. So This right here is your Bullard sell down. Right here. You went from, you lost about 20 cents on the QQQ there. So, thanks, Bullard. As you can see, it really wasn't a big deal relative to the rest of the movement in the day. Probably because he's not a voting member. And guess what? His news is not really news. He's always the dude who's like, higher rates, faster. In fairness, early on, I think he was right when he's like, let's just raise rates and get it over with. I was a big fan for that. Like if you're gonna get punched, I'd rather get punched in the face and then be over it, rather than, you know, this dragging on that we've gotten. I mean, you know, who knows? Maybe there are particular reasons for that. But I don't know. This Bullard news to me is a nothing burger. Again, not a voting member. He's got to give. He's the perfect person. You know what probably goes down is something like this. Neil Kashkari, this is Jerome Powell. You're going to flip-flop, and you're going to agree with the pause. We're going to be unanimous. I don't know why Powell sounds somewhat Trumpian, but it's a horrible accent no matter what. Anyway, you're going to pause. Tell the world you're going to flip-flop because you're worried about the banks or something. And like, oh, J-Pow, I have this paper from 2016 where I talked about the banks having 40% capital requirements. Oh, sorry, Neil. Yeah, that's a great idea. Why don't you use that to explain why you're pausing? Okay, J-Pow. Boy, I can't wait to have your job one day. I'll just keep working hard and hopefully get there one day. Then J-Pow has to call Bullard. Bullard, Neil's voting. He's coming out today as a pauser. I need you to say something bearish. Get on with Bloomberg or text Nick T. We need 2 more hikes. Even though you're not voting, we need to counter some of the bullishness. This needs to be a hawkish pause. Get it done. No problem, Jerome. Hey, Nick T, 2 more rate hikes. I don't know about you, but I just think that's probably honestly how it happens. Like, we would probably all be quite embarrassed to hear the phone calls that happen.